Johan Jooste. He's Chief Investment Officer at Bank of Singapore, joins us right now to talk about all things global, because frankly, global is where the action is. Johan, good having you. Good morning. Thanks so much for joining us at Bloomberg Quint India. What did you make of the Fed's comments, and do they give a consistent tailwind to markets? Because the last quarter has been one of extreme volatility. Will it sober down a bit more now?
I think it will do a little bit. I think the Fed has taken note of some of that volatility, although not that much. I think they also look at the macro, and they'll see that the inflation risk is a little bit lower than it might have been. There's a bit of slowing down in some of the numbers. The oil price, energy complex generally is a bit softer, so they've got cover. They can move a bit on the rhetoric, which they've done. And it comes at a time, like you mentioned, when sentiment was pretty bruised. So at least for the short term, I think this is, something of a panacea, something of a just calm down a bit. Let's see how things go. Later on, things might still change.
Johan, aside from Fed commentary, the other important event is the US and China trade wars, which nonetheless for China has had an impact. We've seen the economic slowdown and the numbers to prove that. And on the other hand, the US equity markets not doing a whole lot much, which again for Donald Trump doesn't do much, because the environment is such where you are seeing the pressure building up due to the US-China trade wars. Do you see that coming to a resolution anytime soon? Because that 90-day moratorium period is going to come to a close very shortly.
I don't think in the long term the US and the Chinese are close enough for us to expect a full-scale, if you like, resolution to the problem. In the short term, I think you can use a phrase something like, there's low-hanging fruit. The Chinese have made a lot of moves. They've introduced legislation. They can point to all of these things. The US might move a little bit on the tariffs. And that can give some comfort in the near term, maybe medium term, and sort of calm markets down. In the long run, the policy objectives of the two sides are quite far apart. I mean, the US essentially is trying to stop the Chinese from doing what they want to do, which is establish a really strong technological base. The US has issues with that. It has issues with the intellectual property rights and a variety of things which are not going to be solved in the short run. And whether that plays directly into firms and their earnings for the next few quarters, that remains to be seen. Longer run, it doesn't look to us as if there's an easy solution for a full-on, okay, that's it, no more talk about trade. That we don't see that.
Corporate earnings also seem to be under question. I mean, while we've seen positive growth numbers coming out from the US over the last few quarters, but that was also a result of the tax benefits that were given to them. So you may not see that coming into play in the coming few quarters. How does that shape up, and what kind of a sentimental impact does that have if you don't see these numbers pick up?
Well, I think that the market knows that not to expect a tax tailwind again for 2019. So the question is, how much of a discount do you take compared to 2018? And it looks like the right number is somewhere between 8 and 10% for the US. So you're moving from, let's say, just rounding up close to 20% for 2018, closer to 10% for 2019. That's what's roughly or should be in the price. So that's where the market has recalibrated itself. Or it should be anyway. We should not be surprised if there isn't, a tax windfall this year. So it's going to be, how does the market do? How do companies fare in terms of delivering relative to a recalibrated number to the left? Where the issue comes in is how much of a further haircut do you have to build in for trade war, if at all, and likewise if growth is a little bit softer, even though it doesn't look like it's going to be that soft. Where does this fit in? So it's much more to do with sort of how we go in the next few quarters, given some of the uncertainties, as opposed to sort of the tax cut which rolls off, which we know more or less is worth, give or take, like I say, 10% on the year.
If the Fed is not on a rate hike course, Johan, and work with an assumption that it is not, would that mean that the perceived threat of outflows from emerging markets would subside considerably, and 2019 might well turn out to be a year of investing in select emerging markets?
It could be a lot better than 2018. I think that the part of the flow out of emerging markets is, like you say, it's a risk-free rate argument. If US rates are so much higher than the hurdle rate for attracting capital, if you're an emerging market, just gets gradually more challenging. If we are indeed in a situation where the Fed does absolutely nothing, that helps the emerging markets. But even if they're pausing, even if we have, like our view is we can still see a hike or two or so this year and maybe even into next year, depending on growth numbers. That might not be catastrophic at all for emerging markets, because even then the speed has receded and the market has had time to adjust. And we do think there's probably an inherent softness maybe to the US dollar. Now keep in mind, when the dollar is strong and rates are going up, this is not great for EM. And at the same time, especially around Asia, you'll probably find a bit of resilience. If you look at the relative performance, Japanese and some of the other markets compared to the US for the last quarter, they actually outperformed because they're already quite cheap. So there's some bright spots for EM, for sure.
Okay, and if that's the scenario indeed, how does India stack up? Because, well, maybe because of the domestic flows looking so strong and saving the market at times of crucial falls, India hasn't fallen as much as some of the other EMs. The percentage returns for the year, maybe dollar terms may have looked wobbly, but in rupee terms, they have been positive as well for calendar year 18. How do you or any of the large global CIOs view India vis-a-vis the other emerging markets?
Well, we'd sort of say again, if you look at the broader picture, not necessarily too bad. I'd say, a certain element of defensiveness comes into play. Now, that I would say helps versus developed markets. It's not necessarily the best thing if you want to go full on in terms of taking risk, because then you probably want slightly more higher beta market. But from the point of view of currency flow, from the point of view of where do you stand in terms of growth, again, I'd say, at least constructive,
Jose, 2019 is going to be a year of which asset class, according to you? While we've been talking primarily about the equity asset class, will it be bonds that will also take that center stage? Will it be commodities? Because you're seeing a lot of flux in terms of what change in interest rates are doing to the commodities market as well.
I would say in the three that you've mentioned there, credit is not particularly appealing. I think 2019 is going to be a challenging year. Let's just get that straight. I mean, I think there's some possible relief in the shorter term, but I do think we're going to have a volatile year. We're seeing the Fed taking liquidity out of the system. We see the ECB possibly starting to do the same. And we've seen in the last quarter of 2018, as liquidity drains, volatility can be higher. So you need to be nimble. But the credit market looks at this point probably a lot more fully valued than stocks. So I think your best guess should be that equity markets could still be the one to deliver your returns very selectively. So you will have the opportunities. I think be more overweight equities at the right time. Fixed income, especially on the credit side, has not corrected particularly much. Again, selectively you can find value, but I think as an asset class, you'd probably find it struggling to outperform equities in 2019.
Johan, while we're talking about the equity markets and what's been happening in the US as well as the other emerging markets, and my colleague already spoke to you about it, but there is a lot of chatter that, for us as a market, for India as a market, the only thing that matters is that there isn't a sudden drop in the US equity markets. If it just about holds its place, then we are fine. Then we don't go anywhere. There is not too much of a carnage that we would see for our equity markets. Is that a view that you would hold as well, where we just need stability to hold on?
Well, it depends on how you view stability. If the US market is sort of drifting a little bit sideways, maybe even weakens, but it's a mild move, then I don't think there's any global market that necessarily has to suffer as a consequence. What you don't want to see is something more systemic. You don't want to see a really large move. You don't want to see sort of a broad risk off. Then what's happening in the US isn't necessarily the driver. It's essentially just a symptom of a broader malaise in the market, and then very few markets are going to really be able to hold up. What you can find in a fairly benign environment is the US can just underperform. There's no reason why the US should be the lead performer in a global market. And from that point of view, if wherever you are in Asia, if you're looking at China, if you're looking at Japan, if you're looking at India, then the fundamentals domestically will be driving, and not just sort of what's happening in the US. I mean, what you're talking about there is a slightly more extreme scenario where, okay, broadly, globally, you've got a risk problem, a risk tolerance issue with investors, and then the EM markets will suffer, but then you will also see the US go down. I don't think you should make that your base case.
Okay. Johan, the other question is the re-emergence of gold. Now, is this just a short-term phenomenon wherein gold is at $1,300 per troy ounce, or would you reckon that there will be some buying of the safe haven as well?
I have to say I'm slightly skeptical of the safe haven argument in the absence of a long-term and well-defined expectation for inflation to go up. If you look at the current scenario, you look at sort of what happened in US bonds over the last 3-4 weeks, that was a flight to quality also. Makes sense because you can still have some yield. Gold pays you no yield, and if inflation is not going up, why would you own gold without any yield? And at the same time, you're not looking at price pressures. The rest of the commodity complex is telling you there isn't price pressure in the short term. So gold is a panic asset in that sense, and I don't think there's reason to panic right now. So I would be, to be honest, somewhat on the skeptical side of a continued move in gold. You have it as a portfolio diversifier, fair enough, up to a point, but I would think that as we go into a period now, hopefully, the Fed's rhetoric, very solid payroll numbers on Friday, and combine that with at least some, at least optical progress in the trade talks. I think gold will have a challenge to maintain levels indefinitely, or at least medium to longer term.
Okay. My final question to you, Johan, what's the market that you're most bullish on? I'm presuming that you have a mandate to invest across markets. What is it that is looking the most attractive market right now?
I think, well, don't ask me what the view is. Ask me where the positioning is. That's put your money where your mouth is. Where's the skin in the game at the moment, and that's Asian equities, right? So, credit we prefer to be a little bit on the light side. Can be selective, a little bit skeptical, certainly of valuations on a relative basis. Anyway, in some of the developed space, Europe has got a few issues of its own. Just given how it's performed lately, doing well from a defensive point of view, but also from a valuation point of view, quite attractive. I'd say the general region would be Asia. There's an overweight there.
Johan, we'll leave it at that. Thank you so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time.
Okay, thank you.
This is a view from the CIO of Bank of Singapore on all things global.